I do want to start with really the we talked about this with Charlie a little earlier. The big theme of memory prices.
Yes.
I mean, because this is what you have to navigate as CFO.
Yes.
Of the company. Demand for flash storage, it's driven prices higher. Margin concern for customers, though it's been a boon to some public companies, including SanDisk, Western Digital, Micron, among others. Component cost inflation, how is that changing the Everpure story?
So it has changed not just the Everpure story, but it has changed the entire industry, because what we're witnessing is a Capex super cycle. And effectively, if you look at the next 3 years, and if you consider the cumulative Capex spend of the hyperscalers, just that group, the estimates vary, but in total, the number that most people would agree is about $3 trillion, right? $3 trillion over the next 3 years. That's two times the defense budget, right? So it's quite extraordinary,
wow,
the
good
amount of money
context.
that goes there. And then off that figure, I've excluded the AI titans, so the likes of Anthropic, OpenAI, and so on. And then you have other players, neoclouds, players like CoreWeave and Crusoe and others. So the demand is real. And so effectively what happens is that the supply is tight, and the industry has to adjust and rebalance the supply-demand equation. And that's what we've gone through. So it is a change that is not temporary. It will revert back once more capacity becomes available, but we don't see that demand-supply imbalance abating before the first half of calendar year 27.
2027.
Yeah.
Will it get back to what will the prices look like then?
The honest answer is no one knows.
Right.
And it really will have to revert back to the mean. How quickly will that be is a big question that everybody's asking. But that is typically what happens. And maybe there is a new mean as well. It may not be back to exactly the same level either, because the world has changed, and now, silicon is much, much more in demand than ever before. Mm-hmm. And that's the practical reality.
So how do you as CFO kind of think about your own needs within your company and balancing the spend where you do overspend because you need to be in it, versus holding back? Because these cycles, right? Like there's a ramp up, and then prices come down. Like you just got to kind of find your way through. So how do you navigate, and how do you make choices right now?
So the trend was very sudden and rapid, and
right.
started to materialize at the end of last calendar year. And you probably heard it from Charlie that the cost of NAND jumped by about 600 to 800%. Now, we are lucky because, by design, I should say, we're lucky to have a great team of engineers at Everpure that have designed solutions that use a limited number of components, and those components are managed by way of software. Mm-hmm. So when you really look at how much of our cost base is truly dependent on components, it's only about 17% of total revenue of the company. And
so that's a big plus.
That's a massive plus.
Yeah.
And so when you are having to face a very large increase on a relatively small proportion of your cost base, you can withstand the shock. But this is not something that was easy by no means. So sorry.
Well, what about customers withstanding the shock? Because
Totally.
Because I'm curious about demand elasticity here, product delays among enterprise customers, or is AI infrastructure modernization remaining so strong that pricing has really not affected demand materially?
No, you're spot on. So we can withstand the shock, but we have to pass some of it to our customers, no question, and we did, but we wanted to share the pain. And so what we have done is we've taken a very intentional approach to the way we priced. Our price increases were more gradual than the competition, and they were also of a lesser magnitude on a cumulative basis. And the reason why we did that, it was very strategic. It was effectively, we did not want to profiteer from the crisis. We wanted to make sure that we manage the business for the long run. Customers have long memories. They won't forget certain things. Mm-hmm. And so what we have done is we wanted to make sure, to your point on demand elasticity, that we don't get to a point where we're testing levels that are unacceptable from a customer standpoint. And so we are very careful in the way we handle pricing. And we are operating, and we've chosen to operate at the lower end of our historical gross margin range. Our gross margin range has been between 65% and 70% on products, and we are operating at 65.5. So really at the bottom, that was intentional because we wanted to make sure that we managed the business for the long run and protected the franchise.
So what do you give up in order to be able to do that? As CFO, where you have to maybe make some choices.
Exactly, and that is about the trade-off you make between having more profits in the short term or more growth in the short and longer term. And we chose, I was a strong advocate that we needed to keep our market share, take a stance, and continue to grow the business and grow the top line. That's why we grew 35%.
So carry that over to clients and customers who are thinking about how much do we spend with you and other companies and entities within kind of the AI build-out, trying to figure out their own ROI and where to spend.
Yeah.
Take us there.
Yeah. So whenever you look at an industry that faces very sharp price increases, what tends to happen with customers who have still the need to spend is there's a flight for quality. And the reason why this is, and particularly important for the AI revolution that we are entering, is that your return on investment is measured over the long run. Therefore, if you invest today, choose carefully and choose the best possible product from a quality standpoint that we stand the test of time. Because the estate that any one of our customers has continues to grow from a fleet standpoint. They have greater and greater data needs all the time, and therefore they have to revert to solutions that will be there with them for the long run. And that's where we come in.
I want to shift the conversation a little bit to talk about revenue mix and sort of where you see that going. The business has shifted. If you look back at fiscal year 2020, subscription revenue was only 25% of total revenue back then. Now it's more than 46% in the most recent fiscal year. How high does that get?
I quite like the fact that we are balanced between product revenue and subscription revenue. That's really, really important. We like the fact that subscription revenue is at about 46%, as you pointed out, but we want to continue to grow product revenue. And the reason why that is that product revenue measures your ability to really penetrate the market and to really expand your market share. Subscription revenue gives you more certainty, more ratable revenue, more certainty on free cash flow in the future. So we need a balance on both. Right now, I would say 54, 46 is actually a good mix. I like it that way.
So as is good, and investors and analysts should think to themselves moving forward, it's going to look like that if all goes according to plan over the next couple of years. It'll continue like that.
Yes, and also the thing that we have to reckon, and when you move revenue that is to a ratable revenue, then you're going to dilute your revenue growth. And the fact that we're growing in totality and on both is a really good sign for our company, and I'm very pleased with that as CFO.
I want to go back to conversations you guys are having with clients, because as everyone continues to play Tarek with AI, it's got some CFOs, as you know, again, I'm going to go back to concerned about their own budgets. Uber has set usage caps after it blew through its AI budget in just 4 months.
Yes.
So what are the patterns you're seeing? Are your customers kind of moving away from experimenting with the technology to budgeting for recurring spending? Like, are we starting to see more of that happening?
That is very hard to tell. I would say you see a bit of both. You still see budgetary expansion, and you also see experimentation. And that's also why our Evergreen One offer, which is an SLA-based offer, whereby you subscribe to a contract that delivers specific levels of performance, is great to cater for those customers who still are uncertain about their budgets and how they want to go about continuing to experiment.
So they have to hit certain performance targets.
We have. We are accountable. We are accountable by contract to our customers to deliver a certain level of performance, and the customer can ignore what the box that delivers a performance and just judge us based on what we deliver for them. And it's a subscription contract that has different terms depending on customer choice, and it helps them experiment and doesn't force them to buy something that they may feel is more expensive. And so you have both. You have customers who go for higher quality systems, they have more defined plans, and you have customers who are still searching for what they want to do, and we help them both ways.
We're always trying to figure out where we are in this cycle right now. I mean, and you have to look at projections. You have to understand where we are and where we're going. Is this a cycle, or are you confident that today's demand is durable and sustainable rather than a temporary infrastructure build-out?
I think it's a super cycle. I am firmly of the belief that this isn't a short burst. I think there's real demand underpinning it. I mean, I go back to my estimate on hyperscalers. It is only representing roughly 90% of their operating cash flow, meaning they can afford it.
But just because you can afford something doesn't mean you should spend.
Oh, totally. Totally agree. But they have very clear plans. Of course, I mean, my book, a budget is never an authorization to spend.
I was just going to say.
But I'm pointing to you that they have a lot of great plans, and their spend and the estimates that brokers have about them point to the fact that they represent about 90% of their operating cash flow. They're not stretching their balance sheet. That's where the uncomfortable zone for a CFO comes. And they can do that, and you have to, if you believe in the AI story of what it can do in terms of changing the world, which most people do, and increasingly do more of, then you can accept that this is not a short burst. It's there to stay.